name is John Browning. I'm the Managing Director of Bands Financial. This is the second video in a small series that we're making about trading in the Chinese commodity markets. This video is about the routes available to trade the Chinese futures markets. The earlier video was the background on China's futures markets, and number 3 will be issues arising in trading futures in the Chinese environment. So in talking about the routes into China, the first thing we must establish is why is it this particular way around? The most salient feature is the foreign exchange issues. Now, this arises from the period immediately after the financial crisis in 2008 in the West. And what happened was that Chinese traders were able to borrow in dollars and bring that money into China at basically low rates. And they did that by using a combination of commodity products, one of which was commodity warrants, particularly copper. And this money went into stock market speculation, property development, and other financings. That after 2015, when we had a stock market fall, led to more regulatory oversight and strict currency transmission rules. Now those rules are still in place. So what we have here is a situation where trading into China is dictated by the access to renminbi and the way through for money to flow into China and out of China in a compliant and regulatory manner. So following 2008, we had a period between, say, 2010 to around about 2017, where we saw a lot of companies going into what are called wholly owned foreign enterprises here in China. That is otherwise known as a WFOE. Following deregulation, particularly between the period 2015 and 2017, opening a foreign-owned enterprise in China become significantly easier. That is because instead of having to get approval, the rules changed in such a way that it became by a negative list. So as long as you weren't operating on anything that was on the negative list, you could open a WFOE. A lot of companies started moving in this direction who had not been in China before. I, in fact, work here in Shanghai in a WFOE. It's owned by our own company in Hong Kong, but that is how I'm allowed to work in China. However, opening a WFOE did not resolve the previous problems of currency transmission. And so they still had to, I wouldn't say get round, but they had to accommodate the issues around currency transmissions as those rules remained unchanged. So, as there's no issues about opening a WFOE, surprisingly, I think for a lot of people, there is a lot of US high-speed traders already have WFOEs here in Shanghai, but they are expensive to run. And one of the problems is running an arbitrage strategy, as an arbitrage strategy is essentially two disconnected companies running a mirror opposite of a strategy. So let me just say that again. Because of the WFOE rules, it creates two disconnected companies running mirror opposites of a strategy. It's expensive in terms of funding for onshore and the offshore company. It's problematic in terms of accounting for arbitrage strategies and complex in transmitting margin from one location, from wherever your head office is, say in Singapore, into your WFOE, so to compensate for for initial margin needs or variation in the margin needs. So if you're doing an arbitrage strategy, you've got one leg operating in your WFOE, the other leg operating in your international company, but trying to commingle the financial needs of those two companies is very difficult, because you've still got the original rules that sprung out of the currency crackdown that happened in 2015. And on top of that, because these two are separate companies, you've got potential for taxation in both companies, which in an arbitrage strategy where one's supposed to be making money and the other one possibly losing money is difficult to reconcile, because you can't get those two companies together onto one balance sheet. One of those things that people talk about is the Qualified Foreign Institutional Investor Scheme, otherwise known as QFII. It was launched in 2002 by the Chinese government, and primarily it was designed to allow certain licensed international investors to invest in China's stock exchanges directly. Although through QFII, they can buy and sell renminbi-denominated A shares or buy and sell other Chinese renminbi-denominated assets. This mechanism was largely replaced by HKEX Stock Connect and Bond Connect. However, following recent changes in the rules, I will make a massive generalization for you. The regulations regarding quotas and prohibitions on buying financial instruments in China as of 1st of November, the QFII regulations have been significantly relaxed, and the access to renminbi with which to buy these assets has been significantly increased. But, and this is key, commodity futures are not yet accessible via the QFII mechanism. And I'll say that again, because I get asked that question a lot. Can I buy futures using QFII? The answer is no, you can't. So what there is available is the Overseas Intermediary mechanism. Now, the Overseas Intermediary mechanism has really come around in the last 2 years, and it's a means of resolving the issues that the WFOEs already have. So a WFOE, as we've already explained, has problems with financial transmission between onshore and offshore. But the Overseas Intermediary, the OI, is outside of China. It is in our case, is in Hong Kong, and is available to trade both the outside commodity future and the inside commodity future from one account that is held outside of China. We're BANS, we are an overseas intermediary, so that the orders flow from the client to Hong Kong, through into Shanghai, into a local broker, and from there into the marketplace, into the Chinese futures exchanges. So the advantage of this is that by holding the account offshore in BANS Financial Hong Kong, the client can trade both, shall we, for example, trade Brent oil futures and Iron E oil futures from the same account. The client's counterpart is the overseas intermediary. And in our case, or in my case, that's BANS Financial in Hong Kong. In effect, the client does not touch China itself. It doesn't have to open a bank account and all that kind of thing. In China, along with your orders, client money is identified on each step of its journey, if not by client name, then by a trading code issued by the Chinese authorities. On BANS order routing systems, the client front end displays the client cash in its account and open positions. and the initial margin, the variation margin in real time, enabling clients to check and recheck their open position and their cash balances both onshore in China and offshore in Hong Kong whenever they require. It's available in real time. The advantage of this, as I'm trying to underline, is that clients can use the OI mechanism basically offshore, and it doesn't have the same financial constraints that opening a WFOE does by opening a company onshore in China. So instead of running two companies, a WFOE and the head office account, shall we say, the advantages of the Overseas Intermediary mechanism is that you have a single account for offshore and onshore trading that optimizes capital usage. You can blend the position within this one account, so there is no need to post money into China. You don't need to do that. That will be done by brokers such as ourselves. It enables a kind of capital optimization. The clients can use US dollars as initial margin at the exchange level, apart from a 5% haircut at the exchange level, which leads to easier regulatory oversight. And cash in and cash out of China can cross the border basically in less than 2 hours. So we are able to remit money into China and out of China in less than 2 hours. Now, at Bairns Financial, we are a Hong Kong licensed futures broker, and our focus is exactly on this. We focus on cross-border arbitrage strategies. Our clients trade extensively both in China's DCE, INE, ZCE exchanges, and against this, they are trading the international venues of CME, COMEX, LME, ICE, SGX, etc. We offer direct market access to several Chinese commodity contracts, including iron ore, crude oil, fuel oil, bonded copper, rubber, palm oil, in a regulatory compliant and tax efficient and capital efficient manner. Who can trade within the Overseas Intermediary mechanism? Well, that's applicable to most offshore entities. There are BVI, there are trust structures, Cayman, Hong Kong, Singaporean, European companies. Opening an account in China is basically a two-step process. First of all, you have to open an account with Bairns Financial in Hong Kong, and then Bairns applies for a trading code from the Chinese regulator that is attached to every order, for every order message, cash movement, etc., that your account does. So the Chinese authorities can look down on your account and see exactly what's happening within that account. That is the same in actual fact for every trader on the Chinese exchanges, whether domestic investor or from overseas. Now, at this point, I should complicate matters, I think, by introducing the concept of overseas special broker participant, which we are on the INE. The advantage of this is that as an overseas OSBP, we can offer co-location to those really high-speed traders that really want to go down that route. And we can offer it for INE, and we are certainly working to offer it on the other exchanges, particularly the DCE. So we have seen the contracts available through the Overseas Intermediary mechanism. On Dalian, we have iron ore and palm oil. On Zhengzhou, we have PTA. And on the INE here in Shanghai, we have crude oil, fuel oil, rubber, and copper. So in review of this second video, we know what we can trade, and we know what structure we should use to trade the Chinese exchanges. And this structure is available to those who want to do directional, and obviously those who want to do arbitrage. And it's available to those people who want a high frequency and those that who take a longer time to realise their investment views. Now, in the last video, which we're going to move on to now, is that there are some arising issues in trading the Chinese futures markets, and I will outline those in video 3.